Good afternoon, everyone, and welcome to this session on our not so new now accounts rules. So our accounts rules were introduced back in November 2019, almost 2 years ago, actually 2 years ago last week. And it's been quite a 2 years, I'm sure you'll agree, but I'm sure we'll talk about that a bit later. So in terms of this session, we want to make it as interactive as possible and to get answers to as many of your questions as we can. So a little bit more about that in a moment. But first, if I can just do some quick introductions. So I'm Liz Rosser. I'm Executive Director of Resources at the SRA. I am a chartered accountant, but I'm definitely not an expert in the accounts rules. But the good news for me and for you is that I am joined by two experts, very much experts, and I'm only asking the questions and they're answering them. So first, can I introduce Sean Hankin, who's our Head of Forensic Investigation and Intelligence. Sean's been with the SRA and previously with the Law Society for over 20 years. Sean's a chartered accountant and specialises in the accounts rules, the role of the reporting accountant, anti-money laundering and financial stability. So welcome, Sean. And second, we're lucky enough to have with us a reporting accountant today. So we've got Andrew Allen, who's a partner at PKF Francis Clark. Andrew advises around 100 firms on a range of areas, including accounting and auditing matters. And he's past chair of the ICAEW's Solicitors Special Interest Group and has actually co-authored the Law Society's Compliance Handbook on the accounts rules. So as I say, lots of expertise for you this afternoon. So how this is going to work is I'm going to have an initial chat with Sean and Andrew to get some of their insights and answers to some of the common queries that we've come across over the last year or two. And then we're going to move on to your questions. We've got some that we've had submitted in advance, but we'd really like to answer as many of your questions live as we possibly can. So to ask questions, you just need to click on the link below this broadcast and submit your question. It's always nice if we can know your name, but if you'd prefer to submit them anonymously, of course you can. So my first question then, just to kick things off, perhaps for you, Sean, you could give us a bit of a reminder of some of the key changes to the accounts rules.
Yes, of course. Good afternoon, everyone. So probably the main difference that will strike you looking at the new rules compared to the 2011 rules is the vast reduction in size, probably about a third of the size of the old rules. And that's because we've stripped out a lot of the prescription that we used to have. So now firms are encouraged to use their own judgment in applying the rules and deciding what's best for them and their firm, along with the bigger picture of what is the biggest risk for them and for their clients' money. It's a far more outcomes focused approach, we feel, and we still, though, have some areas of prescription around things like having to perform client account reconciliations at least every 5 weeks, because we feel that is such a key control that it's still needed to be part of the rules. We've also, for the first time as well, formalized the use of third-party managed accounts. So this is a new area of the rules which allows firms, again, an alternative to holding money in a client account, because any money held in a third-party managed account is not deemed to be client money itself. So they're kind of the main things, and I'm sure we'll touch on other areas that have changed as we move through.
Okay, thanks. Andrew, is there anything you'd like to add to that?
Thank you. Good afternoon, everyone. Thank you, Liz. Just picking up really on a few further points coming out from the rules in terms of what I've seen with the most significant issues with clients, and probably top of the list and most important is the new requirement to reconcile clients' own accounts. And I would say, the vast majority of firms I'm coming across, and let's say 70–75% of firms, are not at the moment complying with that new rule. There are some relaxations which the SRA put forward, which were really helpful actually, because it's quite a big shift technically for firms to do this. And that's meant actually most firms have been relying on that exemption. An incredibly important rule, in my opinion, and if we look back to the previous versions of the rules, I would say it's something that was significantly missing from them. A lot of firms see the client's own account reconciliations as a massive chore, and I understand why that is. However, I would say, having done this for 20, 25 years, if I was to go to a law firm and seek to take client money, the way I would do it is through client's own accounts. And I learnt that from the first day of auditing and opening the probate files and seeing the deposit accounts, passbooks drop out of them and realising that no one looks at these. And that's why it's a really important rule. So for me, I think that's a really important change. I appreciate that's not going to be a popular comment, but if you take the view that actually the reason you have these controls is to protect you as partners in firms from your employees or in my experience, more commonly your partners stealing client money, that's a massively important change for me. In terms of picking up on some of the other aspects, which I see as important and come across day to day, I have quite a few firms that deal with public sector work, so handling LAA, legal aid agency money. Rule 2.33b, of course, now means that that money is no longer deemed to be client money and cannot be held in a client account. Helpful in many ways, but I'm still finding a lot of firms are still trying to catch up on the processes for making sure that money doesn't go into client account. Maybe on a similar sort of note, another significant change I've seen in terms of the rules is Rule 2.2, which is talking about scenarios in particular where if you only hold money for disbursements, expenses and costs, and you don't hold client money for any other reason, then you can avoid potentially having a client account at all and run everything through the office account. Whilst I've not seen many firms using this exemption, I have seen them using it a lot when they're planning for their new future trading structures, and that quite often involves joint ventures under the changes still available from the Legal Services Act. I think just picking up on two other points before maybe we move on, I think two significant changes from my point of view in terms of practical issues would be the ability for firms to set their own timeframes and to set elements of the rules that were previously very prescriptive. I would say there's still significant opportunity there for firms to adapt approaches which are more appropriate for their firm. In 90+% of cases, however, firms seem to be simply carrying on the old timeframes under previous rules, which of course, there's no reason they can't do that. But what we're finding is firms are forgetting that they still need to document that because there is nothing in place in the new rules to say what they're doing. So even if they are following the old rules, they still need to formally document that as part of their practice manual system. And I think the thing that's missing is they're not thinking about where that could work better for them. So there's some opportunities there. I think the only other point I make at this stage is obviously, as Sean was saying, these are more outcomes focused, which works both ways. That works both for the firm, which we'll talk about a bit later on, I suspect, but also for the reporting accountant. And I think it's probably useful for firms to know how reporting accountants form that view. And I think, without going into lots of detail, the thing I would say is it's not just about the breach in front of you. In addition, when a reporting accountant is considering whether something is a serious breach or not, they will take into account more intangible factors such as the attitude of the firm, their past history of performance, a sense of control systems, a sense of honesty, and all of those sorts of things. They all, I'm not saying any one of those is determinant, but they're all a factor when actually reporting on potentially significant breaches.
Okay, thanks, Andrew. I think listening to you takes me back to my auditing days many years ago. It reminds me of some of those questions. So thanks for that. I said earlier that the accounts rules have been in for 2 years, and what a 2 years that is. And so I think we probably ought to touch on the pandemic and how has that impacted. So perhaps, Andrew, if I start back with you, and how has that affected your work as in your reporting accountant role? How's the pandemic changed that?
Well, it's interesting. We've now completed 2 years really of cycles of accountants' reports under this new normal, I guess. If we go back to 2020, I would say there's a few features of that year which are interesting. First of all, we managed to do probably 90+% of our work remotely. And I would say our experience, you could put into two camps there, depending on whether the firm had, whether the law firm concerned had the ability for us to access their system online effectively. And if, to be able to access all the information we need, even up to file review level, if they were working almost on a paperless system. The other end of the spectrum would be firms where their systems just didn't allow that. They were more paper-based, and effectively they had to wait until later in the year when we were able to physically visit their premises. So really, very extreme differences. So ironically, with some firms, we found it, inverted commas, easier, and we got the work done quicker, and vice versa. So some of the relaxations on timescales, which Sean will talk about in a moment, I suspect, were very helpful in that respect. We did have quite a few reports that were signed off late. And if I sort of roll forward to the current year and the ones we've been signing off, mainly September, October deadlines, I think one thing in a way that is slightly unhelpful about what happened last year is there's a slight mentality that firms have got it into their head that the date isn't important when these things are signed off and completed. And I think that's probably an area which needs to be addressed going forward. And if I just make a couple of glib comments at this point, technically, well, not technically, the obligation to submit an accountant's report and obtain an accountant's report rests with the firm. It's not the reporting accountant's responsibility to prepare it, and it's not the reporting accountant's responsibility to submit it if it's qualified. If you then look at that from the other side, and parking the idea of outcomes focused regulation just for a moment, when you hand a qualified report to a law firm and they didn't really want the qualified report, and that might have PII implications and other practical implications, there's no real process for checking that submitted to the SRA. And even if it's not qualified, there's no actual date on the report for the SRA to check it was prepared within the timeframes required. So I think, bearing in mind there's been a bit of a slip of mentality on that, I think that's perhaps a downside, if you like, from working under COVID conditions. Having said that, the efficiency of delivering audits, I think, has improved. Interestingly, coming into this year, when we were able to go out on site, a lot of clients, surprisingly, don't like seeing auditors, and they suggested we might like to work from home still, which is fine. And we've done a lot of that sort of work remotely. What I've been very insistent about, though, is that we don't do all of it remotely. And for people on the call that can remember historical versions of the rules, if you dug down into the detail, if you go back probably quite a few years now, there was originally a requirement that people attended the law firm premises to do this work. And I think that comes back to, first of all, fulfilling one of the purposes of the report, which is a deterrent effect, both to partners and employees in firms, but also going back to my point about how an auditor forms their judgment. And I think it's really important to be on site and to get a sense for how the organisation is run and how the control systems work and the efficiency and attitude of those things. So that's been an interesting sort of process. I think another feature perhaps we saw was difficulty in two things. One has been getting bank letters, and we rely on those to varying degrees depending on how we approach the audit. But it's taken a lot longer to get bank letters, which does cause problems, particularly when firms have got overseas client accounts at times, and you're trying to follow what's going on. That can be very difficult. And if you have any firms in China, you might as well just assume that you're going to be late on filing your report in the first place, because it just takes such a long time to verify the information now. I think the other thing I've found is, from a practical point of view, it's been harder to shut down the files. So, if you take a typical April year end, we might be out doing the field work, we normally do some interim field work probably in January or February before the year end, but we'd be looking to wrap up our field work around July time, let's say. What we've been finding is we're still chasing queries with clients in September, October when we're trying to sign off the report. And cutting to the point of this, I think what we found is when the auditors are on site hassling people, they tend to get a lot quicker answers than if it's by email, when it goes way down the list. People are obviously keen to get the auditors out of the building and off their back, but when it's just in an email trail, it gets forgotten. So I think some of the efficiencies is get clawed back at that point. But anyway, hopefully that gives you a bit of an overview of what we've seen.
Yeah, email overload indeed. Yeah, I think we've all had a bit of that over the last couple of years. So Sean, what about from your perspective in terms of how COVID's affected your role?
Yes, well, the first thing that Andrew just touched on there, we had to do quite early on in the pandemic was issue the guidance around submission of accountants reports, because we appreciated that there would be challenges in meeting that 6-month deadline for submission. So we did do that, and it's good to hear from Andrew that has been helpful. But I think it's fair to say now, and again it touches on something Andrew said as well, is that we would expect firms now to be complying with that 6-month deadline, that they should have overcome any challenges that they did have originally, and be able to meet that and submit their reports to us on time. We do really value the information that we receive in those reports, so I think it's important to get that across. So my unit has the forensic investigation teams who go out and about to visit firms across England and Wales, and as you can imagine, that was a real challenge for us to be able to get out on site. We did issue PPE to all the team, and were intent on making sure that we could still get out on site for the really urgent matters where we felt client money was at risk. And I'm pleased to say we did do that. And we actually had one of our biggest ever interventions during the early stages of the first lockdown, which was a testament to the team in being able to overcome the challenges that they faced in getting out to speak to people and seeing documents and what have you. Again, I'd probably endorse what Andrew said about ways of working. We always knew that the best way to work was to sit across the desk from someone and ask them questions and get documentation from them, and to be able to get a feel for the firm and the characters involved. And it's only been reinforced by what's happened during the pandemic. And it's fair to say that investigations, especially the more complex ones, have taken far longer to do remotely. It's been easier when firms were more electronic, and so they had electronic client files and case management systems, and it's probably sped up our own move from paper to electronic files as well, which has probably gone a lot quicker than it would have done otherwise without that necessity there. So there's lots to take away, but the teams are getting out and about far more common now. It's back to pretty much where we were pre-pandemic now, and that's a good sign, hopefully, going forward.
Great, thank you. And when you've been out visiting firms and you've spoken to firms, have you got a sense of how the firms feel about the new accounts rules?
Yes, so I think anecdotally we've felt that firms have been able to comply with our rules because of the flexibility that we've provided in them. So previously, we would have had prescription around, for example, you need to deposit a client account check within 2 days. Now that we just say that needs to be deposited as soon as practicable, effectively. So it's allowed firms who perhaps live in rural areas who couldn't get into the office as often to still comply with that rule, because they've been able to go in, say, once a week and then go and visit the bank at that point. So that there's a good indication that the flexibility has been beneficial. It's fair to say that there was some teething issues when the rules were first came into force. So Andrew's already mentioned Rule 10 and the difficulties in complying with that rule about clients' own accounts. So we did issue some additional guidance around that, which hopefully everyone has referred to, and it's on our website, and I think everyone needs to look at that if they do operate clients' own accounts. And we also issued some guidance around Rules 2 and 4 and how and when firms should be looking to take costs and transfer disbursements across. So again, that's important for people to look at, and it was thanks to people like Andrew in getting that guidance to a good stage and making sure that it was practical and it would work when it was introduced. We will be evaluating the rules, not just the accounts rules, but our whole suite of standards and regulations. And we've got timelines to do that over the next 1, 3 and 5 years, so that the first year review should be coming out shortly, but all indications are that the new rules have bedded in quite well, and there are no major complications either for firms as solicitors or for clients or for ourselves as the regulator either. And hopefully it's Andrew will say if otherwise, but hopefully it has improved the way the work of the reporting accountant is done, because we changed the role of the reporting accountant to a far more outcomes focused role back in the end of the last part of 2015, and it wasn't until the 2019 rules came into effect that the two really became aligned. So hopefully that has been beneficial for Andrew and his teams.
I think, Andrew, Sean's just asked a question really there. So from your perspective, has it achieved what we'd hoped?
Thanks, Liz. I think it has actually, and it's quite a few years ago now. I remember sitting around various tables when the consultations were going through on the changes. And without trying to just be nice to the SRA, I must say it was a pretty positive experience. I mean, I've dealt with a number of regulators in the past, and I felt it was very open dialogue, and people were willing to look at different ideas. So that, to me, is a good omen for the future. In terms of whether they've worked or not, from my perspective, yes, they have, and I'll tell you why. If I went back 5 or 10 years, with a firm who had some challenges, I might sit down with them at the end of the audit and have a thesis of breaches, which were technical breaches of the rules, and we had to tell them about them, and they didn't really make that much difference to safeguarding client monies. The difficulty was within that 10 pages of breaches, there probably were 2 or 3 issues that were pretty crucial. And what the new rules do is they really focus on those key areas. And so, when I look through, I still have firms with pages of breaches, they still happen, but actually it's much clearer where the issues are. So far, I would say is the real success. We've managed to avoid ending up spending a lot of time dealing on things that are not as important. If we sort of think, in terms of how firms feel about them, I think my experience is they feel the same way. They're more relevant. I think they still worry about the outcomes focused bit, and certainly my advice to firms, and I don't know whether this is what the SRA would recommend or not, but my advice to firms has been to say that the challenge with an outcomes focused environment is that by definition, you do end up with a regulator who is looking at things after the event. And so what becomes incredibly important is to document why you've taken the action you've taken as you go along. So, for example, if I was a COFA and I saw some breaches coming in, let's say they're on residual balances for a topical issue. And, the first 2 or 3, I might sort of think, well, OK, we'll note these in the register. But and I might want to document, say, well, actually, I've only had a few of these. They've been resolved quite quickly. At this stage, this isn't a reportable breach. If by the end of the year, I've got a schedule full of breaches and I go, the fee earners aren't really getting this and they're not complying, actually, my view on whether that first breach at the beginning of the year is reportable might have changed. And it's changed because I've had additional information. So I guess you could look at this as covering your issues, but I think it's really important to keep a document as to why a COFA has made a decision. And I get a lot of calls from COFAs on that sort of point, wanting to know, the 5-minute phone call, and they say, well, should we report this? And the answer I give pretty much every time is it depends. And it depends on a lot of factors. And so you then ask a lot more questions and you get to a conclusion. And I normally say, well, I think you should or shouldn't because of X, Y, and Z. And my next statement is, I don't know whether that's the right answer, but that's my opinion. And if it was me, I would document why I formed that opinion. And unless that's a completely stupid reason, I would hope the regulator would take that into account if they look at it subsequently and think that wasn't a great decision. So those types of issues for firms, I think, are really tricky under the new rules. And I must admit, on my travels, I would say I broadly see two types of firms. Ones that are really diligent and keep these registers, and they think about whether they should report and they document things. And the others where when you ask them if they got a register, it takes them a couple of days to come back to find out whether they've got it. And when you open it up, there's like 2 entries in it from 3 years ago. So I think the message, if I was in a law firm now, in an OFR environment, I would be doing lots of documentation of the decisions I've made on my travels of what I've seen and the problems we've had. I think that's probably sums up my experience so far. But generally, my perception is the rules have been very well received.
Okay, thanks. Now, Sean, your teams have been out on the ground actually monitoring compliance with the new rules. And I'm just wondering, have you seen any particular themes that have been emerging in terms of non-compliance?
Yes, so I think one thing that's come out as a theme that was different is around firms signing off things like client accounts and also maintaining the breaches register properly. So that's been an issue for us. And of course, if client reconciliations, for example, aren't being prepared on a timely basis or aren't being reviewed properly, then it means the errors that they would have highlighted are not being rectified as quickly as possible or as they should have been. So we are seeing situations where breaches have been in existence for longer than we'd like and longer than we'd expect if things were running normally. So again, we'd by now expect firms to have developed new approaches to the sign-off process and making sure that things, whoever is signing reconciliations off knows what they're doing and is fully understands what the reconciliation does and any adjusting items, and that, for example, you're not seeing the same differences appearing month on month. That that you should only see them once, because then they get corrected and are cleared off the following month. We are seeing issues around the misappropriation of client money, and again that comes to the reasons because firms just aren't perhaps scrutinizing payments, so the person who authorizes those payments isn't able to properly look at the file or speak to the fee earner before they sign that off. And again, that's a really important control that needs to be working properly to prevent any either inappropriate payments or errors where payments are made to people who aren't related to that matter. We see now, it's not related to the pandemic at all, but we're seeing far more reports concerning breaches of the money laundering regulations, and that's probably because of the profile that AML has now, quite rightly, and the spotlight that there is on the legal profession. As a regulator, we have our own AML team now, and they do commission our forensic investigation teams to consider issues where there may be AML breaches. And we also have a very good relationship, I think, with agencies such as the NCA and UK FIU, who do refer work to us when they have concerns about firms. And we are starting to see, Andrew alluded to it earlier, and it was something that we did consider when we changed the rules about which accountants' reports need to be submitted to us. We are seeing a trickle of firms now who haven't had accountants' reports prepared when they should have done, and that is a big concern for us. It's an important control, and when we do see that, we are taking serious regulatory action against those firms, because it's not something that should be happening. We do trust firms to have those reports when they need to have them. So it's important that they not only have them, but when they are qualified, that they do submit those reports to us.
Okay, thanks. And Andrew, from the accountant's perspective and your audits, I suppose two questions. One, the same question, any sort of common issues or themes? And also be interested to know, under the new rules, are you qualifying more accounts than you used to or fewer accounts than you used to?
Okay, I'll pick up the common themes first of all. As you'd imagine, as all good accountants should, we keep some schedules of common breaches and the most common issues between firms. And if I just take you through our top 5 for the last couple of years, these are top 5 in terms of volume of issues we come across, but also more importantly, top 5 of situations where we would have qualified a report. So I'm going to work from number 1 upwards, and it is ranked. So the most common reason for us qualifying and the most common reason for a significant breach is a breach of Rule 3.3. So providing banking services, and there are a whole range of these types of situations you come across, and depending on where firms are on the range, and that might be the volume of breaches, but also the nature of them, will determine whether we qualify the report or not. So if I take the lowest end of the range first, or what I deem to be perhaps the lowest risk in terms of risk to client funds, it would be a situation which we fairly frequently come across, whereby, let's say you've got a conveyancing transaction or a probate transaction. You get to the end of the matter, there's some monies left over, and the client says, I don't want the monies, can you pass them across to my son or daughter's ledger because they're buying a house and I'm giving them some money for a deposit? Or you've got a beneficiary who says, I don't want the money, I want my son or daughter to have it, or whatever, and they're a client of the firm and they just transfer the money across to another ledger, or even pay it out to them as an individual. Now, in those circumstances, it's pretty clear from the nature of what's going on why they're doing it. There isn't a series of transactions. The monies could be significant, but fundamentally it doesn't feel like providing banking services, although technically it is. Quite often when you mention those sort of things to the firm, they look at you and think you're a bit nuts, and sort of say, well, we'll just be trying to help the client. And then when you explain to them, actually, no, technically you're providing a banking service because that person wasn't party to the legal transaction, etc., they understand it. So unless you've got a series of those, the first time we come across that, we tend to tell the client, you can't do this, get it right, or next year, if we see the same thing again, it would relate it to a qualification. If I take, completely the opposite end of the spectrum, and a silly example again almost, but I have had this in reality. I found one client once where the terms of engagement, and I don't think I'm exaggerating the terms. They said something along the lines of, you are unable to open a UK bank account at the moment, so therefore we will allow you to use our client account to transact until the end of the year, when you're able to open a bank account of your own. So I was struggling at that point to see why that wasn't the qualification. There were obviously lots of transactions, so you've got a whole range, but that rule causes us the most problem. Number 2 is residual balances, and we still get large numbers of those, and just system issues with firms not being able to manage residual balances properly. Sean will know that one of the biggest costs of shutting down a firm is dealing with residual balances and trying to find homes for them. And Sean will also appreciate, as many will do on the call, that residual balances are a good way of teaming and lading and hiding amounts of client money that have actually been taken out of the system. So they're a really important control. It's not just about being tidy and making sure the one penny goes back to the client when it's left on the ledger. The next one on my list actually is clients' own account reconciliations. We talked about those earlier and how important they are. So we see a lot of firms unable to not devoting resources to complying with that. And I mean, Sean and I have been having some conversations about this rule, even since these rules have been in place. And as I said earlier, I think this is an incredibly important control. I think maybe on the next time round on the rules, we may be able to come up with something that achieves the same thing, but in a less onerous way for firms, because what we're really trying to do here is to make sure people are checking these transactions and that people are not unilaterally able to make payments out of a client's account effectively or client's own account without some supervision. Whether a reconciliation is the best way to do that or not, I think probably is up for debate, but the system, the need to do it is really important. Number 4 on my list would be one Sean picked up on, reconciliations. So probably 3 items I'd say here. Firstly, differences just not picked up, even from simple casting errors in the recs. Not properly undertaking a 3-way reconciliation. It's surprising how many new clients I pick up where you look at their bank recs and it's 2-way, not 3-way. The third one I would say is the COFA not reviewing the bank recs properly. And I'm going to tell a story now from a few years ago. Sean might remember it if he was involved in this one, but I had a client who was being reviewed. It was under a random investigation actually. But my perception, at least, of how these random investigations work is they effectively risk profile the firm by asking for some background information. Once they've got that, they then determine what they're going to do and what they're going to look at. And I remember a meeting a few years ago where the SRA turned up on a site investigation and the COFA asked me to join them for the opening meeting. And the investigating officer had the bank recs for the last 6 months or something in front of them. And they didn't say a great deal. They just pushed them across the table to the COFA and they said, could you just take us through the bank recs? And they said, could you tell us what you do when you check them each month? And the COFA went slightly red. And the COFA had no idea really how to review a bank rec. And it was very clear that they'd just been randomly signing these things off. And the very long-winded story there is to encourage people to have a proper system for doing this. So make sure you review them, make sure you know what it is you're looking for, make sure you sign off and date, and make sure that's done in a timely way around when the reconciliation was prepared. Certainly, what I try to get my clients to do is to have a checklist that each month sits with the bank reconciliations, and the COFA then goes through and works through that checklist and signs off to say they've done it. So things like checking the bank balance of the bank, checking the matter listing balance, looking at old outstanding lodgements and receipts, outstanding payments and lodgements, and just things that are common sense to check the integrity of the reconciliation. And then if you're ever in that situation, you won't need to go red, you'll be able to talk confidently about it. Number 5 on my list, Sean would have a much more appropriate description of this, but we call it sweeping up. It's a bit close to residual balances, but when you get that residual balance with 5 pence on it and you just randomly raise a bill for 5 pence for photocopying and take it across to the office account, we call that sweeping up or theft, depending on which mood we're in. And we still see quite a lot of that. And it's not malicious. It's actually fee earners just being told to tidy up their ledgers, and they think it's a sensible way to do it. And it's about educating fee earners and reminding them you just can't do that. And so that was number 5. So that's the first part of your question. I think your second question was, do we see more or less reports qualified? The short answer is yes, at lower amounts. To give an indication, I would say 1 in 10 of our reports is qualified these days. If I went back, I'm going to go back 15 years, I would say 7 in 10 were qualified. And most of those, it's slightly pointless qualifying them, but because they were all really trivial breaches, but in aggregate, they just looked reportable. So in that context, I personally think the SRA get more relevant information. I think it's interesting to hear Sean's comments about the fact they are picking up some firms that are not preparing accountants reports when they should. I think one consequence of not submitting as many reports as qualify, which is all good news, I think it's good news for everyone, but one thing it does do is it makes it more significant when it is qualified. And so firms are more reluctant to get them submitted. And I think that makes the points Sean was making even more important, actually, moving forward. So anyway, hopefully that was a useful comment on those points.
Thanks, Andrew. And I think lots of hints and tips there for people to make sure you avoid that qualification. So I'm conscious of the time. I'm really keen to get some of these live questions answered. So we've had lots of questions. Just to remind you, can submit them below the broadcast there. So please do keep them coming in. So first one for you, Andrew. If a firm only operates an office account, can clients pay disbursements into it? If so, should it be before or after the firm pays the money onwards?
If you're not receiving client money in any other context, and if you're only ever going to receive money that relates to disbursements, costs and expenses, then you don't need to run a client account. I think that's rule 2.2, isn't it? I don't know, Sean, anything more to add to that one?
It is, yes, it's rule 2.2. So if that, like Andrew says, if that's the only money you have, no need to, well, don't put that in a client account. You just put that into your business account, and you wouldn't need to have the accountant's report work done at the end of the year either, because you'd be because you wouldn't be operating a client account. If you know, if you do have a client account and you're receiving disbursements, then you know you need to consider properly. You know, in those circumstances, you'd only ever put them into the business account really if you already paid them yourself or you're about to pay them, and the liability was with you. They
need to be incurred, don't they? I think is the term, which means you have a liability to pay them, or you have physically paid them. So once you've got, if let's say you've got an invoice from a third party, you've got it on your purchase ledger, it's invoiced to you on behalf of the work you're doing for the client, you've incurred it at that point. You don't physically need to pay the cash out, you just need to have a liability for the firm to make that payment.
Yes.
Okay, thank you. Another one for you then, Sean. Are we required to tell clients before we deduct our costs, or is the invoice sufficient for this?
So the client needs some form of bill or other written intimation of costs. So that's the requirement. So a bill, obviously, if that's given to the client, that's sent to the client, would suffice. Otherwise, to inform them of the amount of the charges that would be that would meet the rules. I think it's important to look at the again, the guidance I referred to on our website around rules 2 and 4 about when to take costs, and making sure always that you're mindful that you're acting in the client's best interest, and it's not about the firm and your cash flow. It needs to be in the client's best interest, and they need to be informed of any risks of you taking that money to your business account.
Okay. Thank you. So I've got a couple of questions now from Stephen. I think maybe the first one for you, if I can, Sean, which is, if you ask for money on account from a new client for your fees only and issue a bill for that money on account, should that money, when received against that bill, be paid into a client account?
So again, this goes to the guidance that we've got around rules 2 and 4. If if you're asking for money on account of costs, so it might be around, so you want £500 on account of costs that you may incur or work that you might do, then that should be paid into a client account, and then once you do that work and you raise the bill, then you're able to transfer that money over from client account to office account, because the client is aware of that amount. So hopefully that answers the question. If you are issuing the bill at the outset, then effectively that is your money, but then you need to consider the dangers of issuing a bill right at the start of the matter, and the risks that could give to the client. But we used to have in the old rules the agreed fee, the concept of the agreed fees. So if you're upfront with the client and you say, well, this work's going to cost £1,000 and we'll bill you up front, and that fee is fixed, it's not going to go any higher, and here are the risks involved in us taking that money now, then that's fine. But you need to make sure you comply with all those areas and make sure you are transparent with the client at the outset.
I'll maybe add to that, because we had some interesting questions in the last session on that, and I echo everything Sean said there. My interpretation is there's an element of being totally transparent with the client. So if your client care and your engagement terms make it clear you're going to charge an amount up front and take that to office on account for your work, so in advance of you doing the work, providing you communicate that and the client is fully aware and they're aware of the risks, as Sean said, that's okay. Being a slightly dull accountant about it, depending on how much of this you do, you will need to do a deferred income calculation as well. And particularly for those firms that are audited out there, you can't just recognise all of this income in your P&L account if you haven't earned it. So you've got the flip side of WIP, if you like. If you're receiving costs up front and billing them, you might need to defer some of that until the future. We had a really interesting point or question raised actually after the last session. Someone came up to me and said, if it was a conveyancing firm actually, and they said, if we build 30% of our fixed fee for the whole matter up front, could we recognise that as income and could we take it to the office account? And Sean may tell me the answer I gave is wrong, but the answer I gave to the person was, providing your terms of engagement make it clear you're going to do that. And in this case, the 33% was actually would accrue to the firm even if the matter did not proceed. So there's an element actually in this case, they had earned it by simply taking the matter on. So it was an abortive fee. The abortive fee was 33%. And it didn't matter how far the matter progressed, providing they actually took it on and started the case, they would get 33%. So this firm wanted to bill it up front and take it to the office account. And under those circumstances, subject to the safeguards I mentioned again, providing the client accepted that, then there's no reason you couldn't do it. I probably, depending if I was in my stat audit mode, I might want to think about deferred income still in that sort of position. But on the face of it, even in that case, you probably have earned it because contractually you had the right to the income at that point.
Okay, thank you. So Andrew and Sean, you've both touched on Rule 10 a little bit, and I know this did come up when we did the face-to-face conference last week. It was a bit of a theme as well. So Andrew, perhaps I could ask you, how have firms tried to comply with the new Rule 10 in practice? And have you got any tips for firms in this area?
So reconciliation of clients' own accounts. I would say it's interesting, actually. Some firms I've come across were doing this already. Not many, I have to say, but some were doing it already. They were generally running it as a spreadsheet and a sort of system separate to their main client funds system. I've had some firms that have positively taken steps to put systems in place so that they can do this, and they've put them alongside their other client monies, albeit they're not client monies, obviously, but they've used a function on their system similar to deposit accounts, designated deposit accounts, whereby they can record transactions on them. And they've got systems with fee earners to make sure they reconcile the bank accounts and get the information from third parties where they've been transacting on the accounts. The other end of the spectrum, and I would say, if I'm being totally honest, probably 50+% of the firms I come across, they are relying to the most tenuous level on the exemptions the SRA have given and the minimum level of requirement about retaining registers, etc., etc. So I think there's a lot more work to do there. And from the comments I made earlier, I think there is value to doing that. And if I just say why that's the case, and I'm sure we'll remember this from the original session. I mean, I've been signing off reports for 25 years, and the two most significant frauds that I've seen with client monies involved partners in the firm taking client money. And the importance of, I'm bound to say this, appreciate the self-interest in this statement, but the importance of a reporting accountant and having the deterrent effect is actually making sure a client money audit is done thoroughly, because it is assurance for the other partners in the firm that there's not systems or there's not weaknesses that enable your partners to nick some money off you effectively. And I'll remind people that PII does not cover theft from a client account by a partner.
Okay. On that note, then, another question actually that came up last week was about negative interest rates, which I know are happening for real in Europe. So perhaps, Sean, I'll ask you this one. What are the SRA's views about recharging clients when firms are holding money in accounts that have negative interest rates?
Yes, happy to take that one. So it doesn't look like we'll get any negative sterling interest rates. I think the only way they're going is up at the moment, but euro accounts, we are seeing that some of those have tilted into negative territory now. In terms of our position as the regulator, there isn't any guidance on our website at present, but there's no prohibition from firms doing that. I think the main message to get across to firms is if you're in this position, you need to be transparent with your client. You need to be upfront about the potential costs and how any charges will be calculated. And you need to do that as soon as possible. So ideally, you do that at the start of any retainer so that clients are able to compare the cost of coming to you with the cost of going to another firm, or you do it as soon as is reasonably practicable for you to do that. So again, the client can make an informed choice when they're in that position. It's not a simple process, though, in terms of recharging the those costs to the client. You need to make sure that you weren't making any profit on it yourself. You'd need to be careful how you calculated those fees, and then you've got to also think whether you'd need to charge VAT on them, which is a whole other minefield. So it's not simple. And the more I thought about this the other day, that perhaps the best way to overcome it is if you've got a client, a big corporate client, for example, you might want to consider putting that money into a separate designated deposit account, which might then make it easier for you to account for the exact amount of interest you're being charged for holding money on their behalf.
Okay, thank you. So a couple more questions that have come through. I think I'll hand over now. So one from Raymond here on Rule 5.2. 5.2 says you must appropriately authorize and supervise all withdrawals made from a client account. Can this be done via an email?
You gonna take that one, Andrew?
I'd be very nervous by that, to be honest with you. I mean, I'm tempted to say yes, because you should theoretically, if your systems are safe and you think they're secure, then you should be able to accept notification and agreement by email. My hesitancy, and I'll give an example of fraud we actually had quite a few years ago in our firm, whereby we were emailing clients, a client in particular, with confirming their tax payments, and they innocently asked, can you give us details as to how we make the payment? So we obviously reply and give them HMRC's bank account numbers, and the email gets intercepted and the details are changed to divert the money. So my concern is, I guess the answer is yes, but it depends on how much information you're including in emails, and whether that enables any cyber interference to interfere with that, really. I think that would be my comment. I mean, it's interesting. I've had a couple of similar questions the last couple of months from firms who have very large numbers of BACS payments to approve each day, and unsurprisingly, these relate to conveyancing firms. And the questions are largely centered around, does a partner have to confirm these every time and review them every time? And I mean, I think strictly the answer is no. However, in practice, I've never come across a firm that has systems whereby an electronic payment isn't approved by a partner or a member at some point in the chain. So I guess I've dodged that question a bit and given both answers. I think if it was me, I would say no in my firm, but I could see if you put proper systems in place, it could be acceptable.
Okay, I don't know, Sean, if you wanted to add to that. I think that the summary was maybe yes in theory, but perhaps not in practice the best approach.
Yes, I think that's right. You'd have to be able, as the ultimate signatory or person signing, authorizing the payment, you'd have to be able to satisfy yourself to a reasonable standard that that payment was legitimate and you can properly authorize it in the circumstances.
Okay, thank you. I've got another question that's come through from Elizabeth. If the same client has two ongoing matters at the firm in two different departments, can the firm transfer money between the matters?
So if I take that one, well, the main thing is that the client is aware of it. So, you know, we're not worried in those circumstances about the firm acting as a banking facility, because it's just a transfer between clients. So as long as the client is aware and you're able to fully account for any money you've received or paid out on the matters at the end of the retainer, then there's not an issue with that.
I think one area we come across in practice, Sean, quite a lot, where people get confused on that, is there is a very big difference between me being a sole shareholder of a company, which is a client, and me being a client in my own right, because at that point the company is not me. There is a difference between me and the company, and you couldn't transfer money from my personal ledger to my company's ledger, because that would be banking services.
Definitely.
And people, yeah. And to be fair, people think that's okay, not maliciously. They just don't understand that a company is a separate legal entity, and that applies to an LLP or a business which is owned by your spouse, or etc., etc. There are lots of circumstances. I was just thinking aloud, Sean, if you were transferring from a sole ledger to a ledger with your spouse, that would be okay, wouldn't it?
Yes. And it was more that I was thinking of a situation where you might have a matrimonial matter and a conveyance, you know, running side by side. But like you said, you have to distinguish between that and then any work you do for a company as well, and who you're acting, consider who you're acting for and who your client is in those circumstances.
Okay, thanks. So let's see if we can get through 2 or 3 more questions then. So a question from Martin. If the firm only does fixed fee work, so going into the office account, can the client pay in further money to cover disbursements?
Can I take that, Andrew?
Yeah, I think that says yes, isn't it? Because you're back to the same rule 2.2. I think you're saying in that situation actually that the only thing you're doing is billing the client for fees and disbursements. So, I mean, whether or not you have a client account, I don't think you need it in that situation potentially. But no, the money can go straight into the office account.
Yeah, it's just that distinction around the incurred bit, isn't it? You just need to make sure that those disbursements are incurred and that you are liable for them at that point.
Okay.
Yeah, and I think that's the important point, is incurred, as we were saying earlier, doesn't mean you've paid them. You just need to have created a legal obligation to pay them.
Okay, thanks. And you talked about sweeping up earlier, Andrew. So in terms of sweeping up, is it permissible to donate small ledger balances less than £10 to charity with the client's permission?
Providing you've got the client's permission, yes, you can.
Yeah, I think those are the words, keywords at the end.
Yes, yeah. Or the alternative under the rules, of course, is if you're not able to contact the client, providing you make sufficient efforts and you document those in terms of trying to find the client and proportionate to the amount involved, even if you don't have their permission in those circumstances, providing the amount is below £500, you can donate that as well.
Okay, and Sean, question for you. The £10,000 limit for an accounting audit, does a one-off month over £10 trigger the need to have that audit?
Okay, so over the £10,000, there's 2 criteria. So it's one, that the balance doesn't go over £250,000 at any point. The second criteria is that the average of the reconciliation balances should be less than £10,000. So if you've got 12 months where the balance is £9,000 for 11 months and it goes to £11,000 for 1 month, the average would still be less than £10,000, so that would be okay, and it wouldn't mean that you had to have the accountant's report in that year. So hopefully that makes sense. But there's some, I think, very good guidance on our website, which then goes into some quite detailed worked examples of exactly that type of scenario, which hopefully you'll find useful.
Okay, thanks. I'm conscious of the time. Maybe we can slip one final question in. A question from Violet. Does it matter if VAT on disbursements be on an invoice or completion statement? Who'd like to take that one?
Andrew's the VAT expert, I think.
Can you say that again, please? Sorry, Liz. Could you say that again, please, Liz?
Oh, yes. Sorry, Andrew. Apologies. Yeah, it says, does it matter if VAT on disbursements be on invoice or completion statement?
Well, they've got to be on the invoice if VAT is due. So that's not optional. The normal question about disbursements is whether you've got to pay VAT in the first place, but assuming they're VATable, you've definitely got to show them on the invoice, otherwise it's not a valid VAT invoice. Whether the VAT is on the completion statement, I don't think there's any regulation around completion statements, certainly not from a VAT point of view. So I would say you could do either, quite frankly, on a completion statement.
Yeah, I'd agree with that. You could just you could have it as the gross amount or analyze it out separately, but it's got to be in there in some form, or the figures won't balance.
Brilliant. Thank you for that. So thank you very much, Sean and Andrew, for taking those questions very quickly and on the hoof at the end. It was good to get so many in. And apologies if we didn't get to your question. We will look at those questions to see whether there's any themes we can pick up in future webinars. And of course, if you've got any specific queries, then perhaps you could give our ethics helpline a call. I'd definitely recommend them, and they can offer support on any particular individual queries that you have. Well, I think it's been a good session, but it'd be really good to get some feedback from you. So please, could you click on the feedback link below the session? Do let us know your views and whether the format worked, because we're really keen to do as much as we can to make these sessions as useful as we can. In terms of further sessions being shown this week, we've got some tomorrow. We've got one on how transparent information benefits solicitors and their clients, and one on cybercrime best practice and common pitfalls. If you take a look at the SRA events page, you'll see details about these and all the other virtual events running this week. So please have a look and find some other ones which hopefully will be interesting to you. Thank you again. It's really good. Thank you to our speakers, and thank you to all of us for joining us either virtually or last week at the conference. And hopefully it'd be good to see you all again soon, as I say, either virtually or at our conference in future years. So thanks again. Bye all.